Hello and welcome back to Financial Future. Today, we're delving into the latest insights about the U.S. economy and the Federal Reserve's upcoming plans. We're facing a challenging economic landscape, and it's essential to understand what's in store for us. In just 2 weeks, the Federal Reserve is scheduled to hold its next FOMC meeting, concluding on November 1. This meeting will determine whether the interest rates will rise or remain steady. Anticipating their moves isn't too complicated if we connect the dots. Let's dive into the details of the Fed's master plan. According to the latest Fed minutes, the data suggests that the U.S. GDP is experiencing a solid surge in the third quarter, while the labor market remains tight, with unemployment at a historic low of 3.8%. Despite these positives, inflation remains a pressing concern, well above the Fed's 2% target. Looking ahead, the Federal Reserve staff forecasts that inflation will likely settle around 3.5% by the end of this year, with a gradual decline in the coming years. Their aim is to bring it down to 2% by 2026, implying a prolonged effort. It's worth noting that their primary focus on the labor market aims to address wage inflation by creating a more balanced supply and demand equilibrium. While the Federal Reserve may present their plans as aiming for a softer labor market, the underlying intention is to curb wage inflation by slowing down the economy and increasing unemployment. Therefore, keeping a close eye on the job market and the JOLTS reports is critical. However, the Fed staff also acknowledges the risks associated with their inflation forecasts. Should inflation persist longer than expected, it could significantly impact their economic projections. Consequently, maintaining higher interest rates for an extended period could potentially impede economic growth. Taking a closer look at U.S. households, the Fed highlights two distinct groups: those with strong balance sheets and those struggling with high inflation and depleting savings. This aligns with the recent data from the Federal Reserve survey, which revealed that a significant portion of middle and lower income households had exhausted their pandemic savings, relying on credit to meet their daily expenses. With the upcoming Fed meeting on November 1, the likelihood of a rate hike appears slim, with a 94% chance of no change, as per the CME Fed Watch tool. Similarly, the subsequent December meeting shows a 70% chance of rates remaining unchanged. However, the Fed has projected a potential quarter-point increase to 5.75%. Considering this, the possibility of a Fed pivot is something to watch out for in 2024, as it would mark a turning point in the interest rate trajectory and potentially signal a gradual economic recovery. Nevertheless, it's essential to remember that the enduring repercussions of the current economic situation will continue to affect the lives of many Americans for years to come. As we move forward, I'll keep you updated on the developments leading up to the November 1 FOMC meeting. Stay informed, stay prepared, and together, let's navigate this economic landscape. Don't forget to subscribe for more updates, and thank you for your continued support. Have a great day and take care.